Welcome to another episode of Equity Street, where we provide the roadmap to property wealth. We're answering the questions of real estate investors across the country, and of course, I am joined by one of Australia's leading property experts, Matthew Bauer, to answer your questions. So let's get straight on into it. Right, Gemma and Jamin have asked, Matt, interested to know your thoughts on negative gearing. We're going to open up a can of worms here with you, mate.
Wow. We certainly will. This will be a great debate, as it always is, around negative gearing or positive cash flow or neutral or anything in between. And there's plenty of pundits that will argue the point around negative gearing being the devil and avoid it at all costs and so on and so forth. And then there's plenty of people that will talk around the positive cash flow component as well. Look, I guess when you put it in the context of building a portfolio and being successful in expanding a portfolio, there's room for both. From a negative gearing point of view, I've always taken the observation that it isn't a strategy in itself, because essentially you're not wanting to lose money on purpose, unless, of course, there's a 3 or 5-fold or 10-fold return on that loss that you carry. And what I mean by that is really the overarching strategy is capital growth. It's a case of looking at it as a benefit to you as an individual as to whether negative gearing is the right approach for you. But I sort of look at it and say, as example, if a property is costing me $50 or $100 per week in negative gearing, or $2,500 or $5,000 per year, but that same output is achieving $50,000, $60,000, $70,000 per year in capital growth, then it's still, I guess, a pretty decent return. So it has its purpose in your portfolio, because primarily when we look at that situation, it's a capital growth that you're really after, and it's about affordability and how that relates to your own personal cash flow situation as to whether negative gearing is good for you. But I think it's been less of a conversation these days, particularly with this low interest rate environment, where you'll find what used to cost $150 or $200 per week to run and hold a property is now could be less than $50 per week, or in some cases even less than that, depending on what market you're in, and I guess really as the name suggests, what gearing level you take into that. And the easiest way to improve that over and above the property itself is to go in with a larger deposit, more cash funds in the deposit, and borrow less against the individual asset itself to improve that cash flow position and turn what could be a negatively geared property into at least a neutral cash flow property, and therefore costing you nothing to hold as part of your overall portfolio approach. So it has its purpose, and the argument also might be, well, I'm not a high income earner. Where is the real benefit to me on that basis versus a high income earner making, I don't know, for example, maybe it's 180 or 200,000 plus in income, where they're paying a lot of tax. So there's a significant benefit to that person to negative gear. But I can assure you, we have clients as part of our network, part of our family, that are making $90,000 a year and making $400,000 or $500,000 a year. Everyone wants to achieve a capital growth outcome for their portfolio, pay the least amount of tax as possible, and even more so, the least amount of money out of their own pocket. So putting the context of a portfolio sense, then it has its place. And if you use it smartly with the right finance structure in place, then it can certainly help you enhance a very profitable portfolio.